Hello and welcome to Commodity Champions, your weekly dose of what's brewing in the commodity space. I'm Manisha Gupta. Let's start first with a recap of what the week was in sense of commodities. And starting off with the crude oil prices, where we have seen the prices hit the highest in 27 months. Whether you see the weekly basis or today or on a monthly basis as well, the crude oil prices is a space that's standing in the green there. Well, you have seen the demand estimates continue to be strong. The markets are anticipating a rebalancing as soon as the first half of 2018. And there also has been supply disruptions and the inventories in the global markets declining. And all of that has been supportive. Take a look at then on the other commodities where you have seen the base metal prices actually hit in a bit of a profit taking. Whether it's copper or lead or tin, all of those metals actually saw a bit of a decline coming in. It has to do with the strength in US dollar, which have led to pressure into many of these commodities. Also remember, the industrial metals had been rising because of supply concerns. All of those strong fundamentals are still into the market. It really is about the strength in US dollar and some profit taking that has brought these prices down. But even then, you have a couple of major gainers here. For example, nickel is something that continued to lead the rally. The markets are anticipating a strong steel demand, and that has been supportive. The other one, of course, has been aluminum, which has hit a 6-year highs in this week itself. Not such a great week when it comes to the gold and silver prices. On a weekly and a monthly basis, we have seen a bit of a pressure continue here. It's a 3-week lows for gold and silver prices. Again, the strength in US dollar is making these sector weak as well. To discuss this further, we have with us now David Lennox, who's analyst, Fat Profits. And also joining us is Mark Do, Head Research, Wing Fung Financial Group. David, hi, let me start with you first. And how would you look back at 2017? Would you say there have been lots of factors really which have been supporting for commodities?
Look, as you have a look at 2017, as we're now approaching the last couple of months of this year, we certainly have seen a very good recovery in the commodities space. Primarily, it's been on the back of a couple of things. Firstly, a weaker US dollar over the course of 2017. And also the fact that we're now starting to see the markets growing more concerned about supply constraint and demand remaining quite robust going into 2018. And that would suggest that a number of the commodities may, over the course of next year, go into supply-constrained positions. So that bodes well for, we believe, commodities through the course of 2018. Of course, if you throw your mind back a couple of years, we have been through one of the worst cycles that we've probably seen in commodity prices. So really, at this point in time, we're only just at the bottom, we think, of the upcycle.
Mark, the same question to you as well, really, because there have been so many moving pieces of the puzzle. Even now, the markets are awaiting the leadership transition in US Fed. How would you read into that, and what impact would that have on the commodities as a space?
Basically, I think the most important determinant for investor concerns is that we are all waiting for the new Fed chairperson. I think the decision is very important for the monetary policy and the implications for asset allocation, including commodities and other asset classes. At this very moment, I think President Trump should better let Janet Yellen to keep her role. But I think to be more pragmatic, if we have to choose another person, I think John B. Taylor should be the person, because I think a rule-based decision-making process should be more transparent, and it facilitates the expectations management during the post-QE era. I think it is very important for investors, because it helps stabilize the market during the unwinding of the balance sheet. And for the commodities market on the whole, I think the supply and demand conditions is very good, because we can see that the global economic recovery is so good that the central bankers are willing or more optimistic to have the unwinding of the balance sheet. I think it is a very positive note.
Well, that point is well taken. But when it comes to metals, while this week hasn't been so positive, David, would you say that because the metals are still standing tall, they actually have been the outperformers in 2017? The kind of declines that perhaps we have seen in this week are buying opportunity. And also, what would your top pick be?
Look, if you have a look at, we think across the broader base metals in 2018, you're going to find that all of them, we believe, will perform quite well. If we had to individually pick base metals, we would be continuing to favour zinc. If you have a look at those fundamentals, the zinc market is already in supply-constrained positions. And if we see demand continuing to grow, we do believe that the current dwindling of resources or inventories will continue, and that's going to push the zinc price even higher in 2018. Behind zinc, we would be certainly looking at the copper market. We don't believe that in 2017 it's gone into supply deficit, but we certainly do believe in 2018 it will. And if we see the same price movements that we saw with zinc in terms of when that market was finally into deficit, then the copper price will be, we believe, a very strong mover in 2018. Then we'd be looking behind that to nickel, probably not going into supply constrained in 2018, but certainly it may go close. But if the other commodities are running quite strongly, then certainly we believe the nickel price will run as well.
All right, that's about the metals where zinc is a top performer. Aluminum and nickel, of course, could follow behind. But David, what's your sense with the gold prices really? Because it has been the US dollar impact that we've seen come in for these prices. And even as the dollar is closing this year in the negative, we haven't seen that kind of a run-up come in for gold prices.
No, it hasn't. And if you have a look at the US dollar, it's been the biggest driver, we believe, of the direction of the gold price and the precious metals for the course of the last couple of years. In 2016, the dollar was higher and the gold price was somewhat labouring. In 2017, we saw the US dollar start to weaken and the gold price firmed up. In between, we've seen spikes in the gold price because of geopolitical events. At the moment, the market's looking very closely at which direction the dollar's going to go, the US dollar's going to go in 2018. And there are a couple of factors that will govern that. Firstly, are we going to have a dove or a hawk sitting in the federal chair in 2018? If it's a hawk, then we'd have to watch for the US dollar because higher interest rates will push the US dollar higher and unfortunately got the gold price lower. If it's a dove and Janet Yellen perhaps stays in the job, then we can see that US dollar not rallying quite as strongly, and certainly that's very good for the gold price.
David, that point well taken. Where do you see the gold prices headed then? Where do you see this year closing? And what's your estimate now for 2018?
At the moment, we've still only got an end-of-year price for gold. We're working on those ranges for 2018 now. But we kept our gold price at $1,400. At this point, it looks like a bridge too far away in terms of getting there, primarily because we think that the US dollar may just continue to just strengthen a little bit over the course of this year, and that'll put pressure on the gold price. In 2018, you've got to watch out for inflation. It has hit a high base in 2017, but we do think in 2018 inflation is going to accelerate, and that's going to help the gold price going forward. Again, it's going to be the direction of the US dollar that's just going to perhaps temper or push how hard that gold price is going to run next year. If we had to set a range, we'd probably be looking at somewhere between $1,600 and $1,700 for 2018.
David, before we let you go, I want to really put in a couple of crude oil questions as well, because this week is going quite bullish down when you talk about this. 27-month highs, would you say that the prices are headed much higher from these current levels as well?
Look, certainly, yes. We think that going into the end of 2017, and again, we kept our year-end price at $65 for Brent and $65 for WTI and $67 for Brent, primarily on the back of, we believe, when we're looking into 2018, much closer to the end of this year, that demand for oil is going to be very robust, and we believe that supply will continue to remain quite constrained. And that's really going to put quite a good rally into the oil price, we believe, going into the end of this year. If it doesn't come this year, we certainly believe that in 2018 we will see a much stronger oil price.
All right, so while you are talking about 65 and 67 kind of levels for this year, what's your sense for 2018 then? Would you look at much higher prices?
Look, at this stage, we haven't set our 2018 ranges, but given where it's trading at the moment, we have got that end-of-year close at 65 for WTI. It would probably be maybe into the 70 to perhaps $80 region if we had to set a range. That's where we would be looking. But at the moment, we've got another couple of months before we really sit down, or another month before we really sit down and look at how the numbers may fall together in 2018.
All right, those are very bullish views coming in for the crude and the gold prices going forward. David, thank you so much for joining us. We'll let you go at that. But Mark, coming back to you, what's your sense for the range for gold prices? Because David clearly thinks that we are headed towards 1,400, even higher kind of levels for gold.
Well, for the trading range, I think gold price should have a range bounded within 1,250 to 1,300 at this very moment. I think it may last 2 or 3 weeks because we can all see that for the past few months, even though there had been some kind of a geopolitical tension between the United States and the North Korea, we can all see that the positive factor that comes from the risk aversion did not have enough support to push the gold price to beyond 1,400. I think it now becomes a significant resistance level. And right now, even the 1,300 level is also another resistance level. But overall speaking, I still think that it is still being range bounded. I think 1,200 should be relatively robust as a support because after all, the changing landscape of the geopolitical environment, I think it somehow supports the gold price. But overall speaking, the monetary policy should dominate the whole picture in the coming few years.
All right, so $1,200 per ounce is a good support. On the higher side, once $1,300 is taken, $1,400 per ounce is possible for gold. But Mark, how are you looking at the base metal prices? I mean, we have seen strong fundamentals for copper, aluminum, zinc, etc. What are you picking up here?
For the investors with a relatively short-term horizon, I think it is a very good bet on copper prices because we can see that if mainland China is going to succeed in managing its soft landing and to have the economic statistics stabilize at around the current level, I think based on the past experience in the last decade, we can all see that a cyclical factor may set in. And I think for all the real economy to have to experience a more better experience of the recovery, I think copper prices should be rather sensitive and should be the leading indicator for the other commodity prices. So I would like to bet on and go bullish on copper prices at this very moment.
All right, Mark, we'll let you go at that. Thank you so much for sharing your views and your strategies on all of those commodities. So clearly, both our experts are bullish when it comes to precious metals and crude oil as well into 2017 as we end that year and 2018 as well. But with that, we'll take a short break. When we come back, we will talk about the crude oil prices on where are they headed. We will have Ms. Mahesh joining us for exactly that.